Welcome back to FinSight Global, your home for clear, global insights on finance, investing, and long-term wealth strategy. Today, we're tackling one of the most important questions investors are asking in 2025. Should you hold cash or buy the dip? Is now the time to wait or the time to act? With markets shifting, inflation cooling, interest rates uncertain, and tech stocks on the move again, it's critical to understand what holding cash really means and what you might be missing out on if you don't take action. This is your 2025 Wealth Strategy Breakdown. Let's get started. Chapter 1. Where are we now in 2025? Before we make any decisions, let's get clear on the current landscape. After the volatile bear markets of 2022 and early 2023, most major indices have recovered, but not evenly. Tech has rebounded, energy is cooling, real estate is mixed, and emerging markets are still lagging. Inflation has been brought down from its peak, but it's not gone. Central banks have paused rate hikes, and some are considering rate cuts later this year. There's cautious optimism, but also a lot of uncertainty. And in this environment, two strategies have emerged. 1. Sit on cash and wait for better clarity. 2. Or buy the dip, believing the worst is already priced in. Chapter 2. The case for holding cash. Let's start with the conservative approach, holding cash. Cash might seem boring, but it has real advantages right now. Reason 1. Optionality. Cash is flexibility. It gives you the power to wait, to pounce, or to stay safe if things get worse. In uncertain times, that's valuable. Reason 2. Short-term yields are strong. High-yield savings accounts, money market funds, and 3 to 6-month treasury bills are offering 4 to 5% returns with zero market risk. That's a solid return just for waiting. Reason 3. Risk of market correction. Many analysts warn that stocks, especially tech, may be overbought again. If corporate earnings miss expectations or interest rate cuts are delayed, we could see another dip. Holding cash gives you firepower to buy at better prices later. Reason 4. Peace of mind. If you're nearing retirement, planning a big purchase, or just value low volatility, cash offers psychological comfort. No red days, no panic selling, no emotional roller coaster. But cash isn't perfect. Chapter 3. The risks of holding cash. Let's talk about the downsides of staying in cash too long. Risk 1. Inflation still hurts. Even at 3% inflation, your cash loses buying power every year. Over 5 years, that's nearly a 15% reduction in real value. Risk 2. Opportunity cost. If the market continues to rise, sitting on cash means missing gains, especially in growth sectors like AI, clean energy, and cloud infrastructure. Risk 3. Emotional traps. Waiting for the perfect moment often leads to paralysis by analysis. Many investors who held cash in 2020 or 2022 never re-entered and missed massive rebounds. So while cash offers safety, it's not a strategy for long-term wealth building. Chapter 4. The case for buying the dip. Now let's look at the more aggressive path, buying the dip in 2025. Many investors believe that now is the right time to build positions while prices are still reasonable. Reason 1. Market momentum is returning. The S&P 500 and Nasdaq have recovered significantly from 2022 lows, but haven't hit euphoric highs yet. Some analysts say we're in the early stages of a new bull market. Reason 2. AI and innovation cycles. AI, automation, and cloud computing are reshaping industries. Companies leading this shift, like Nvidia, Microsoft, and others, are growing earnings and expanding market share. Buying now could capture long-term growth. Reason 3, central banks may pivot. If the Fed or ECB starts cutting rates in late 2025, it could trigger a massive rally in stocks and real estate. Getting in before that happens can maximize gains. Reason 4, timing the market. The best investors don't try to time bottoms, they invest steadily and ride the long-term trend. Chapter 5. What smart investors are doing. Let's peek into the playbook of savvy investors in 2025. They're not going all in or all out. They're doing this: dollar cost averaging, DCA. Investing small amounts consistently, no matter the market mood. It reduces timing risk and builds positions gradually. Barbell strategy, splitting the portfolio. One side in safe, stable assets like cash and bonds. One side in high upside risk assets like growth stocks, crypto, or real estate. Diversification, spreading across sectors, geographies, and asset classes. That includes US stocks, emerging markets, commodities, and even alternative investments like REITs or private equity funds. Watching key signals. Smart investors are watching inflation trends, earnings reports, Fed meeting minutes, bond yield curves, unemployment data. They act based on data, not emotion. Chapter 6. Strategy recommendations. So what should you do? Here's how to think about your 2025 wealth strategy based on risk level. If you're conservative, keep 50% in cash or short-term bonds. Invest the rest in ETFs or dividend stocks. DCA monthly into the market. Avoid leverage and speculative trades. If you're balanced, hold 20-30% in cash. DCA into growth sectors plus global ETFs. Consider sector plays like tech, clean energy, and healthcare. Use dips as entry points, not fear triggers. If you're aggressive, keep 5-10% in cash for quick moves. Target undervalued innovation stocks. Look at global small caps, emerging markets, or crypto. But set stop losses and manage risk tightly. Chapter 7. Mistakes to avoid. Whether you hold cash or buy dips, avoid these common traps. Going all in. Timing the exact bottom is nearly impossible. Spread your entries. Ignoring risk. Even strong sectors can drop. Never invest blindly. Research and diversify. FOMO buying. Don't chase hype. Buy based on valuation and long-term conviction, not headlines. Never updating strategy. Markets change. Your plan should evolve too. Review monthly or quarterly. Chapter 8. Global Outlook. Don't forget the global picture. Asia is recovering faster than expected. Europe faces recession fears. Latin America and Africa offer value, but with higher risk. Dull US markets are still the most liquid and innovative, but also crowded. Global diversification in 2025 is more important than ever. Don't just think in dollars, think in global allocation. Chapter 9. What we recommend. Here at FinSight Global, we believe holding some cash is wise, but waiting too long can cost you. The smart path is balance. 1. Build dry powder. 2. Deploy strategically. 3. Stay diversified. 4. And most importantly, stay consistent. Wealth isn't built by reacting emotionally. It's built through smart, steady decisions in both fear and optimism. Thanks for watching FinSight Global. If this video helped clarify your 2025 strategy, don't forget to like, subscribe, and tell us in the comments. Are you holding cash or buying the dip? This channel is here to help you make global financial decisions with confidence. Until next time, stay smart, stay global, stay invested.